Hi, everybody who's joined. I think we're going to wait a few minutes as people come in. Feel free to add your name to the chat and any kind of introductory comments as we're getting set. All right, I think we've got a critical mass. We're a couple minutes past the half hour, so we'll get rolling. Devin, um, welcome everybody to this webinar. I'm very excited for this conversation. My name is Charles Kustin. I'm the portfolio manager for impact investments at the MacArthur Foundation. And Devin, if you go to the next slide. So I'm going to make some opening context setting remarks on the webinar. And then the highlight today are our three panelists. So the three panelists are Santiago Alvarez from Alive, Keisha Cash from Impact America, and Stephen Vicinelli from Social Finance. So let's go to the next slides for the context setting. So C3, so let me start with the definition of what we mean by catalytic capital. And we define catalytic capital as capital that it refers to debt, equity, guarantees, and other investments that accept disproportionate risk and/or concessionary returns relative to a conventional investment in order to generate positive impact and enable third-party investment that otherwise would not be possible. So it's important here for that context that we view catalytic capital as investment capital, but it can take any form of investment. And C3 emerged out of a narrative that developed about a decade ago about this concept that there was this, what we call the no trade-off narrative, that as impact investment was emerging as a field and as a way of investing, there was a narrative that was emerging that all impact investments could generate market rates of return with no trade-offs required. And while we view that as entirely possible for a wide range of capital, what we call the spectrum of capital, we also view there to be a role for catalytic capital. And in conversations with other deployers of catalytic capital, we saw the need to gather together as a group, and we formed the Catalytic Capital Consortium, which is an investment, learning, and market development initiative that was launched in 2019. And the goal of C3 is to enable a more just, equitable, and resilient world by promoting the understanding and use of catalytic capital. And again, I want to emphasize that we embrace the full spectrum of capital. And if you think about the spectrum of capital, from being at one end purely philanthropic funds that have only philanthropic aims as their purpose, that's grant capital, and at the other end of the spectrum as financial only traditional investment capital that doesn't factor in impact at all. And in between those two, you may have things like what used to be called SRI, or socially responsible investing, ESG investing, exclusionary investing of that sort, that seeks market rates of return but factors impact consideration. And then catalytic capital, which is closer to the philanthropic end of the spectrum. It's investment capital, but it's capital that prioritizes impact and not risk-adjusted rates of return. There are 13 funding partners in the Catalytic Capital Consortium. So the initial three funding partners were the MacArthur Foundation, the Omidyar Network, and the Rockefeller Foundation. And in the second phase of C3, we've been joined by a whole host of fantastic partners that are listed here on the slide. We've launched a website about a year or two ago, which has the very short and catchy URL of catalyticcapitalconsortium.org. It's listed here. And it's a very helpful resource, and I would encourage everybody on the webinar to go to that website afterwards to see the resources that we've developed and that are stored there. So let's go to the next slide. So as I mentioned, C3 is an investment and market development initiative, and critical to that is a set of grants. So the grant making overview here, the initial wave of grants was $10 million, and the second wave of grants, second phase of grants, is $6.4 million pool of capital. And it's doing the grant capital has been used for a variety of things, including developing a community of support, a community of practice supported by our network partners. That's described in more detail on the website. And then in phase one, we've already allocated and distributed $9.2 million of grants supporting 34 organizations. The reports that have come out of those grants, those market building reports, are all on the Catalytic Capital Consortium website. So let's go to the next slide and talk about the investments. So in addition to the grant making, which was jointly funded by the funding partners, MacArthur Foundation funded a set of investments. And the investments include $128.5 million invested in 15 field partnerships. And just to define the terms, when we talk about field partnerships, those are essentially funds and investments. Two of those investments were curated with partners. So we curated investment in the Zero Gap Fund with the Rockefeller Foundation and curated an investment with the Packard Foundation as well. The other initial 9 investments came through a curated call for proposals that we held in 2019. And we built this portfolio, and through that curated call for proposals, we received over 100 proposals and selected 9 out of that 100+ set of proposals to create a portfolio that was intentionally diverse by geography, by impact type, by capital type, and by funds that were both blended and unblended. And at the fund level, these field partnerships included $2 billion of investments from other sources of capital, as you can see on the bottom part of the slide. And those 15 investment funds or field partnerships have gone on to make over 200 investments in a wide range of enterprises, addressing virtually all of the sustainable development goals. The 3 largest sustainable development goals addressed by the partners are SDG 8, decent work and economic growth, SDG 10, reduced inequalities, and SDG 13, climate action. Let's go to the next slide. So earlier this year, we published an initial impact measurement and management report on the portfolio. And a handful of themes emerged from that report that are listed here on the slides. And the first was to prioritize support for local managers and emerging market funds. Included in those emerging market funds is the Acumen Latin American Growth Fund, and you'll hear from Santiago Alvarez. We also have Encore Capital in India. And in both cases, we were seeking to address the specific needs of those locations and mobilize additional capital, both from local and international sources. The second theme is around the challenges and potential of innovative structures. So one of those innovative structures is the Up Fund that was created by Social Finance. Stephen Vicinelli is here to talk about that. The Up Fund is a pioneering mechanism to expand access to adult education among low-income and underserved people, creating a pathway to improve career and earnings outcomes. And Social Finance learned a great deal from this effort, and Stephen will talk about how they put those learnings to use. A third theme is what we call horizontal capital. And when we launched the curated call for proposals back in 2019, and we had expected and planned for the majority of the investments to be in blended finance transactions, and we sometimes refer to that as vertical capital. So in other words, the catalytic capital will be combined with other forms of capital and more traditional capital to create a stack of combined capital. And what we found with the proposals is there was a compelling group of investments, many of which we made, that were not blended in what we call horizontal capital, so a single pool of only catalytic capital. And it's important to note that catalytic capital can be in blended finance transactions, but it doesn't have to be. It can take, in some cases, higher perceived risk and still seek market rates of return in order to support early or first-time managers or to support different forms of innovation. The formal proposal pool, I mentioned that earlier, that we both helped to we both curated some two of the initial 11 investments, and then the balance came through a proposal pool, and we saw benefits of taking both approaches. And then finally, the potential for mobilized capital, as I noted in the earlier slide. All told, there's more than $3 billion of capital that's been mobilized through this portfolio. The report, the IMM report that Ermi shared the link in the chat. If you go there, there's a lot more detail about these observations, and also how the way that we think about capital mobilization and calculate that. Going on to the next slide. So why are we here today? So we were very excited to launch that report and share with everybody some observations that we've made at the portfolio level based on conversations and reporting from the various field partnerships. But we also wanted to have the opportunity to hear directly from a handful of the field partners about what they've learned. And we wanted to go to deeper on specific lessons learned. And in all three cases, the field partners that are here on the call with us today have gone on to raise additional capital. And so the idea here is that the field partners will talk about Fund One, learnings from that Fund One, and then how those learnings were put into place into the subsequent fund or funds. The commonalities across all of these panelists is that they have clear and focused strategies. Again, they've learned from Fund One and they put those learnings to use in subsequent funds, but there are differences here too. So as noted, the C3 portfolio by design is diverse, and so there are a range of impact sectors represented here, a range of geographies, and a range of lessons learned. So I'm going to hand it off to Santiago Alvarez from Alive. I'll let him introduce himself and his fund, and then he will hand it off when he's done. When each of the three panelists have presented their funds and their learnings, will then go to a moderated discussion, moderated by Deepa Iyer, and then we'll have an opportunity at the end of the webinar for the participants to chime in with their questions. So with that, I'm going to hand it off to Santiago.
Thank you, Charles. Just quick introduction. My name is Santiago Alvarez. I'm a co-founder and managing partner of Alive Ventures. We are really proud to have the Catalytic Capital Consortium as partners from our first fund, and also MacArthur Foundation leading the way through first and second fund. I'm going to share a little bit about Alive's journey, but I'll go fairly quickly on what we're doing to save time to go through I think what's interesting about the discussion, which is the learning about how we came about Fund Two and what adjustments we did from our first fund. So very quickly, we were launched in 2016. Initially with the support of Acumen, the global NGO that had operations globally and operations also in Latin America. But Acumen, sort of being a nonprofit organization initially focused on the pioneer space, supported us, my business partner and I, sort of in launching Alive as a way sort of to continue growing the spectrum of capital. Alive is a impact fund in the sense sort of that we only invest in businesses that are trying to address the inequality gap in Latin America. But we do it also from a market perspective. Sort of, we receive investors' capital from a different pool of LPs, and what we're trying to do is to prove the thesis that you can do investments that they have both financial returns, but then also intentional impact along the way. And so, as mentioned, we started in 2016. It took us about 2 years to fundraise for our first fund. It was a very grueling 2-year process with many challenges, but luckily we received sort of the backing of roughly 20 investors, many being international, but then also some being local, which was that was great. And the C3 was one of those sort of very important sort of investors at the beginning of Alive's formation, providing that catalytic capital that help sort of came Alive to life. Our first fund was a $28 million fund, and it is still, focused on the Latin America, initially with a concentration in the Andean region, mostly Colombia and Peru. And then it was a structure as a sectorial fund, investing primarily in agriculture, energy, and education, with a gender lens across those 3 dimensions. And investing early growth capital, meaning we would not do pre-seed seed investments, but actually more investing in companies that they had already proven their business model and they require is capital to scale. That was sort of our first fund, first closed in 2018. We invested over that fund over the life of the first 3 years. And then at the end of 2021 and throughout 2022, we were fundraising sort of for our second fund, which is a $55 million fund, continues focused on Latin America, but where we changed sort of our strategy is not a sectoral strategy, but it's actually a thematic impact approach that we are now taking sort of to investing, and now concentrating in 3 impact themes that we call sustainable income generation opportunities. The second one, access to critical goods and services. The third one, education and pathways to quality jobs, with a gender and climate lens across the way. Can we change to the next slide, please? This is a quick snapshot in terms of how Alive has grown over the last is going to be 10 years today since we started sort of the fundraising process, and wanted sort of to highlight sort of along those years how Alive has been able sort of to succeed thanks sort of to the collaboration and partnership of really very important stakeholders along the way. Initially, the Inter-American Development Bank was also sort of the anchor investor for our first fund. And then we were able sort of to get other important partners and affiliations, sort of that they provided kind of a stamp of approval for the quality of the work that Alive has been doing over the years. And so out of 2021, we became an emerging impact manager of Impact Alpha, Impact Assets 50. We became also a 2X Global founding member, thanks sort of to the work that we had been done from the onset in terms of gender lens investing. And now we are also proud sort of to say that we are an Impact Assets 50 manager since 2024. We've been investing sort of, as mentioned, sort of across different impact themes. You can see it sort of in this slide. Sort of we have invested in education technology, access to education. We've invested in agribusiness. We've invested in access sort of to renewable sources of energy. We've invested in solutions sort of that facilitate the access to formal jobs, which in Latin America, we believe it to be a ticket out of poverty, given that when you access a formal job, you get social security, you get pension, you get healthcare. And we've done that also, strategically sort of to diversify sort of our portfolio and the risks sort of that we're taking. Our first fund, as mentioned, it was a $28 million fund that we invested in 8 portfolio companies. Because we have what we believe is a conviction approach to investing, not the traditional venture approach of spray and pray, but actually in the markets in which we operate, we believe entrepreneurs, they face many challenges, not only access to capital, and therefore a life structure has been set up sort of to be able to support founders across many different dimensions in terms of providing support in how they expand to different markets, how they measure impact, how they look at the sort of gender integration, how they sort of optimize sort of their cap structure, and to be able to do that, we need to be very selective sort of in terms of the companies that we support, because we will not be able sort of to provide that level of support sort of to a very broad portfolio. Our second fund is slightly more diversified. I think that was also sort of an important learning from our first fund. That even though we still maintain sort of that conviction strategy, the portfolio thesis of having a diversified pool of assets, it's quite important. So our second fund is having now roughly 13 to 14 assets. Can we go to the next slide, please? And this is our kind of the 3 main sort of highlights or reflections that I wanted sort of to share with the audience in terms of the learnings that we've had along the way to be successful in terms of raising sort of a second fund in an environment that globally has been very challenging, because as I'm sure you all have navigated, the last 3-4 years have been very challenging sort of in the sort of entrepreneurial ecosystem after kind of the free money and the pandemic and the impacts that had in terms of funding. Alive sort of set out sort of to launch our second fund, when in the midst of sort of that crisis, and I think the main learnings that we had is that for there to be a second fund, financial performance was key. Even though we are an impact fund, even though sort of impact is front and center for our strategy, we're not positioned within the spectrum of capital. We're not positioned in terms of providing concessional capital. What we are positioned, and our strategy is very intentional in terms of providing both impact and financial performance. And what we really saw from the investors that we approached sort of that second time around that we went out to the market is that to start the conversation, impact alone was not enough. Impact, it was very important sort of for many, but for probably a good proportion of investors sort of that we wanted sort of to bring to the table to be able to raise a larger fund, financial performance had to be there. And that meant sort of that the portfolio that we built for our first fund, which was our presentation later in terms of financial performance, because DPI at that point in time, of course, was still very limited. It was critical. So portfolio one fund performance became, something that investors started sort of to scrutinize significantly. And even though performance was still in paper because of the lack of exits at that point in time, they become sort of our presentation letter. So this is, it might sound probably that is kind of a basic, but it's actually not. And we found along the way that many sort of impact investors, they confuse that the language or the communication around sort of impact and financial performance being, well, we were having impact and that should be enough. And in our experience, that was not the case. Financial performance was still very important. Of course, impact performance was also very, very, very important front and center. Um, Thankfully, our portfolio was achieving both. For a life, impact performance is also tied sort of to our incentives and compensation. And when we came out sort of to fundraise for our second fund, the impact performance was being top tier at that point in time. Second learning that was crucial for us, and I think in our strategy of raising our second fund, was the first fund investors were crucial to really get off on our second fund. And I think this is very important for everyone sort of to understand sort of a fund manager cycle. That is a 10-year cycle. And when you're raising sort of our first fund, you get capital from what you could be called probably the believers. Fundraising as a first-time fund manager is extremely challenging because you're fundraising on the back of your previous experience in other managers or doing other stuff. And but the strategy you're putting forth is new for investors, and so you get there sort of the capital of the believers. For your second fund, you are halfway through the life of your first fund, meaning DPI almost zero. We have at that point in time 0.15 DPI, so very limited. Thankfully, there was some, but limited. And so the question was, okay, like how you raise capital then? And what we found, extremely important was the backing of our first fund LPs. Having the support of first fund LPs in your second fund, so doubling down on a manager, provides a signaling effect that is crucial and catalytic, because that means sort of that first fund that they've known you for now 3, 4, 5 years, even though they haven't received their money back because of the lack of DPI, they are still happy with the work that you're doing. They believe in you. And so they are, if they show they're willing sort of to double down on this manager, it gives a very, very strong signal sort of to the market. And so very practically, our first close back in 2023, it was a 20 million first close, so relatively small sort of to our strategy, but it was funded almost entirely by the first fund investors. Now, that gave us the possibility to show that the second fund was a reality, that the second, gave us the possibility to start deploying capital. And that really opened the door to new prospects and new investors that now with the, having seen the first fund and the backing of investors in the second fund, they stepped in sort of and they took time to actually analyze the opportunity of our second fund. So critical, relationships with first fund investors. Here, for example, with MacArthur Foundation, it was a very a strong partnership. I think that we were able sort of to build together along the years. And thankfully, we received the backing of them sort of for a second fund. And not only them, but actually 80% of our first fund investors participated in that second close, in that first close of our second fund, which became really important. And lastly, but not less important, is that from the onset, when we set out sort of to fundraise our first fund, I think we spoke with probably 400 or 500 potential investors, and ultimately we ended up with 20. And I mean, I don't know if this might be different for the US, but in the context of Latin America, raising capital at that point in time, we had to overcome many hurdles. The first one being, the like venture strategy, like venture capital in Latin America 10 years ago was practically new for the vast majority of investors. And so we came sort of with a kind of venture approach of investing in early stage, early growth companies. And we had sort of to overcome that hurdle. But then again, there was the next hurdle was it's not only a venture strategy, it's not only investing in early growth companies, it's actually investing with an impact intentional approach. And so ultimately, I'm sharing this because what we realized is that with the execution of our first fund, we needed to eliminate all potential barriers or hurdles that investors have with our strategy, so that when we go to the market to the second fund, we hopefully things would be easier. And I think we were successful in that, in the sense that with our first fund execution, we were very rigorous in terms of how we would do our investors relationship, our reporting, all our underwriting. The active engagement sort of with LPs for them sort of to feel they were part of a community, not, that Alive was not a black box in which they would send checks and then just, hope receive news by the end of the year or checks back hopefully years after, but actually, a space where everyone was able sort of to share their expertise, their knowledge, share learnings and learn along the way. So all that process and all that work of building a very robust platform was, we believe, sort of to be critical, so that when we went out to the market sort of to raise a second fund, existing investors felt trustworthy, but then also potential new investors, they were able sort of to see the work that we had done over the years. And they felt it was, relatively quicker, sort of the possibility to build trust among them about sort of the quality of Alive's work. So I'm going to stop there, just being cautious of time, and then, happy sort of to delve deeper as we go along into the Q&A session. And over to you, Keisha.
Hi there. Hi, everyone. My name is Keisha Cash. I'm the co-founder and general partner of Impact America Fund. We exist to scale impact for low and moderate income people in America. Santiago did a fantastic job really talking about the evolution, sort of the structural evolution of a fund and fundraising. We share a lot of the same challenges as well as learnings as he described. I'll kick it off by talking a little bit about my thesis, how I developed my thesis and sort of the evolution of thesis development, and then we'll walk through some of the data on the slides here. What I'll say is that our initial fund was really a $10 million fund. It was sort of fund 0.5, and then we raised a $55 million fund. And then our third and most recent fund was the $112 million fund. But taking a step back, my thesis for Impact America Fund, or at least my why and my mission, really stems from my own personal background. I grew up in Orange County, but was considered low income due to our family income. My mother utilized welfare benefits, Section 8 housing, food stamps. I've told this story before, but I think it's important to understand my why. And growing up in that low income household, but being exposed to much more wealth than our household had, here in Orange County, which I'm actually back in Orange County after a long journey from bouncing from the East Coast to the West Coast. First generation college student, UC Berkeley, found my way to Wall Street as an investment banking analyst. And then after my time on Wall Street and seeing a lot of money move, I came back to California and started working in Los Angeles with really small mom and pop local businesses, and had the inspiration by these businesses, seeing business owners work day and night, the realization, they were just as smart and had just as hard, maybe even a harder work ethic than some folks I saw in New York on Wall Street, but had no access to capital. So I sort of took it on as a mission to support these small businesses, became sort of a rogue venture capitalist, investing a little bit of my money, raising money from Wall Street colleagues that were still on Wall Street to invest small dollars into these small businesses. Did that work for a while, and this was sort of around Hurricane Katrina hitting, and before the 2008 market crash, that I started to feel tensions, quote unquote, sort of on Main Street. Small businesses that I was working with and supporting, revenue started to dry up a bit. And I thought to myself, I love doing this work. How do I do this work at scale? So that led me to Columbia Business School. During my summer, I know we have a lot of folks calling in internationally. During my summer at Columbia Business School, I had the opportunity to work at Bridges Ventures in the UK. And that was really my sort of eye-opening experience of being at an institutional firm that was investing in low and moderate income communities in the UK. I had experiences of doing due diligence and going out in the field and working with that team, being a part of pipeline meetings. And once I got to experience and see Bridges Ventures, I had the idea, there are best practices here. Saw investments that actually worked because they identified the willingness for people in low and moderate income communities to pay for services like gym memberships, right? And so there is no lack of sort of a desire to be healthier or have more income, but the lack of products and services that was, and continues to the lack of products and services being offered to low and moderate income people. So I had that experience, came back, fired up to Columbia Business School, and then organized an event that led me to meet Josh Mellman, who is and continues to be in my mind an institution all into himself. He was investing his own capital and also working with a very large family office to deploy capital into solutions to scale impact, primarily in emerging markets, but also had come to the conclusion that we need to get more capital out here in the US, specifically to communities of color. Josh Mellman and I started working together while I was still a student at Columbia, and then I had the opportunity to continue that work with him after graduating, and it was Josh Mellman and that family office that anchored that $10 million Fund One. And so combining all of those experiences, my background working on Main Street with small businesses, getting the institutional experience at Bridges Ventures, working at a family office, led to me being in a position to launch that $10 million Fund One. And then going on to raise the $55 million Fund Two and the $112 million Fund Three. So it was a journey. Standing up any venture fund is a journey. Setting up a venture fund that invests in products and services that are scaling impact for low and moderate income people with the idea of systems change and focusing on the racial wealth gap is also a journey and very difficult to do. So I appreciate the ecosystem of investors that have been focused on this work. And now we see more funds like Impact America Fund that are in market, and we're glad to have played a role, a pioneering role, to open up the opportunities for us to all focus on low and moderate income people in America. So speaking a little bit about the fund, Fund 2, the $55 million fund, our first real institutional fund that MacArthur played a huge role into catalyzing. We were started raising that fund in 2018 and had been raising for a while, and this opportunity came about for us to apply to the Catalytic Capital Consortium funding, and we went through a very rigorous process to then secure MacArthur as an anchor investor, and then many other investors after that crowded into the fund to help us not only reach our $50 million target, but to exceed it. That fundraise took 2 years. So Santiago said a grueling raise. My fund 1 also took 2 years. A grueling raise, but an important raise, in that we closed the fund in 2020 when the protests were happening in the streets of America. And we're obviously during a pandemic as well, but we were able to get that fund closed in 2020. A good portion of our capital came from Catalytic quote unquote investors, or mission-driven investors, likely more than what I am showing here, the mix. I expect there are many more investors that are more focused. They're not focused on financial returns, but more focused on impact than I know by the name that shows up in their subdocs. Fund 3, MacArthur also supported Fund 3, a much larger fund. We raised this fund, thankfully, within a year in 2022, right before the crash that Santiago talked about. So certainly been a journey. We've shifted slightly in terms of how we're thinking about the types of investments we're making, but that shift is not due to or in response to our mission. Our mission is still the same, always has been, will continue to be, to focus on low and moderate income people here in America. Next slide. And so quickly, and we can talk more about the learnings in Q&A, and this is really for folks that I know that are in the audience that are building institutions, venture firms, and other organizations, debt funds. The managers I talked to today are probably 2 or 3 steps ahead of me in thinking about structure. But one thing that we didn't think about as carefully as I do encourage folks to think about now is the structure of the fund model or the debt model. We have done, and I'm thankful we've been in a position to do it, a lot of ecosystem building, a lot of wraparound support without having really the structure nor the capacity as a small fund to do that work, but we did that work. And it has been a pleasure to do that work, but it has been work that a venture fund, again, typically does not have kind of the budget or the muscle at our size to do. So I appreciate funds that I see now that are setting up nonprofits from day one to support some of the wraparound support and other ways of thinking about how do you stack capital to get a venture fund or a debt fund or another type of vehicle up and running, but then to provide the type of support that the companies need. So I would encourage everyone to think creatively about the structure, and for investors to consider supporting not just the debt portion of a fund, but also the operating budget so that the team can scale and get to a place of financial stability. Fund managers, and this is for investors in fund managers, to make sure teams have enough overhead, have enough capital to cover overhead, but more specifically to pay themselves and their team. This work is a pleasure. I'm up at 7 a.m. this morning for this call, 6 a.m. To be on call by 7 a.m. So there's no work that I'd rather be doing than this work, but it's really hard work, and it's emotional, taxing work at times. And as a Black woman leading a fund, and I know other Black leaders. Not only are you a fund manager, but you're also being a representative for large numbers of people that don't have a seat at the table. And as we're experiencing now in the US, you're also being attacked. And so this work is challenging work. It's difficult work. We love to do the work as managers of this capital with the goal of getting it distributed to large numbers of people in the communities we care about. But it's hard. And so teams deserve to be taken care of. Teams deserve to make sure that they're financially stable and well so that they can carry on the work, as their best selves. And then lastly, iterate, measure, and reset. This has been a journey, as Santiago said. There's so many lessons learned as a first-time fund manager. I have a finance background, Wall Street. I have an MBA. I worked at Bridges Ventures. I worked at a family office, and there's still more to learn when you're actually managing the institutional capital and the back office and the legal and the vendors, and you're hiring people, and you're supporting portfolio companies, and you're making investments. And so learn the lessons. And I'm thankful to have such a great group of LPs that understand that we're on a journey together, a learning journey to figure out how to invest at the intersection of impact and financial returns, but to do so to scale that impact. So we get up every day with a mission to scale impact. If we start to make investments that have great financial returns, but they're not serving the people that we care about, then we failed, regardless of that financial outcome. So take time to iterate, measure, and reset, and be sure, and I'm talking to folks that are managing these organizations, that you are identifying a set of investors. We all want LPs and we want to raise a lot of money, but make sure you're identifying a set of investors that truly believe in the opportunity and will give you the space, grace, and time to iterate, measure, reset, and learn the lessons as you build your institution. And that's it. Now I'll pass it on now to social finance.
Okay. Keisha and Santiago, those were amazingly inspiring stories. Thank you so much. Every time I hear stories like that, I learn a ton. And as a relative newcomer to Impact, I really appreciate that. My name is Stephen Vicinelli. I lead Social Finance's Impact First investments team. I will interchangeably use Impact First and Catalytic throughout the conversation. But to begin with, I'd like to give a shout out to everyone at the Catalytic Capital Consortium. You guys have done an amazing job of paving the way for many of us to do this work. You're a role model to follow in building the field, and that's a really important part of what we try to do every day. So thank you for that. Let me start with a little bit about social finance. We are a 125-person organization located in 5 offices across the U.S. We've got an interesting legal structure in that we are a 501c3 nonprofit, but we are also a registered investment advisor. And you're going to hear me talk about a bunch of different things that we do at social finance, and that structure enables us to do that. There is a through line to all of our seemingly disjointed work, and that is fundamentally to mobilize more capital towards impact. So almost everything that we do, you can look at, you'll see that through line. The team that I lead at Social Finance is a smallish group of about 10 folks. We're focused entirely on helping people, institutions, foundations mobilizing investment dollars towards impact. And we do it by advising community foundations, donor-advised funds, individuals, families on the how-tos of impact first investing. And we also do it by managing a portfolio of investment funds that typically try to offer easy, affordable access to impact. But my team was born out of a sister group at Social Finance known as the Workforce and Education Investments Team that's led by my friend and colleague, Jake Edwards, who you've probably heard from on other C3 webinars. This is a bigger team at Social Finance, about 30 folks, and where we really got our start in impact first investing. I'm going to center most of my comments today on the work of that team, and in particular, as you heard at the outset from Charles, on the Up Fund, which was really our first foray into impact first investing with a commingled standalone fund. So as you see on the slide, the details on the left-hand page that say initial fund are the details of the upfund. $50 million fund, 100% catalytic capital from a mix of foundations and high net worth individuals, entirely focused on workforce and education, and it was a debt fund. We have since evolved, as you see on the right-hand side of the page, in a number of different funds, which I'll come to later on, that have expanded the types of investments that we make. The investor mix has remained somewhat consistent throughout. So I should mention, obviously, that the upfund was a MacArthur investment, C3 investment, and in the spirit of sticking with the topic today of sort of moving from Fund 1 to Fund 2 and scaling Catalytic Capital, there is a before and an after to the story that I think would be interesting for me to talk a little bit about. But if I can digress for just a moment, and if I could ask the slide czar to move to the next page, actually one more page. I have these overly verbose insights that I was so impressed with Keisha and Santiago's very to the point. So I felt like I had to address them in these comments. But I want to focus on the third point, and that is that you really have to think of these funds as long-term commitments, almost like marriages, and you really have to select your partners wisely, ensure that you're doing your part in the sustaining the relationship. And we undoubtedly got that from MacArthur in the upfund and helping us through a number of successfully and candidly challenging moments in designing and investing the fund. And as I go on to say, as I'll go on, hopefully, we're upholding that side of the bargain as well. Okay, we can go back to the prior slide because I think exactly that slide, because this will show you a little bit of the evolution. Unlike the prior speakers, we're managing a broad swath of funds that do a lot of different things. And so I thought it would be helpful to go back to the sort of origins of our work. When we were founded in 2011, we were focusing almost all of our time on what's known as social impact bonds. We lovingly call these SIBs. You'll hear a lot of acronyms from me, but I will hopefully get all the words out. These were pretty intentional and effective pools of capital. Raise impact capital, scale a typically government-funded or government-enabled program that could be put into work with this capital. And then eventually the government will repay that capital and its investors if the program delivers results. Call it pay for success. As deliberate as we were about SIBs, they did run into a number of problems, and you can imagine some of those. First of all, it took an army, literally, to choreograph all the players, right? You have government, you have investors, service providers, evaluators, the list went on and on. Secondly, the design work involved was pretty intense, pretty complicated, and most importantly, it was not repeatable. And as you know, investors are often looking to you for what is your repeatable process that gives you an investment edge. Finally, and this is relevant probably in all investment situations, past performance is not indicative of future results. And because each one of these SIBs was a unique animal and was different in kind, it was hard for investors to understand what outcomes and results we were seeking, different one from the other. And so the pattern that investors typically look for to assess the viability of future investments was harder and harder. But those learnings, painful at times, really set the stage for us to raise this first dedicated pool of catalytic capital back in 2020. We called it the Upfund. And the pivot that we made from social impact bonds, I'd probably categorize in three different ways. So number one, the demand for these catalytic investment tools was there. That was absolutely clear. There was, in fact, an unmet demand to link both impactful outcomes with financial return. And the philanthropic community wanted more of these. So that was sort of where we started everything. Secondly, economic mobility as an issue area was one where our SIBs had had the most success. And so, economic mobility takes different forms, but it's an obvious area where catalytic capital can have a real impact in closing capital gaps. And so, again, the acronyms, we converted SIBs into KIBs. And KIBs stand for Career Impact Bonds. And that's what the Upfund was really set up to invest in. So, obviously, the other important point to mention is that having a dedicated pool of capital to do a multitude of these is invaluable. I remember working in the traditional finance world with fundless sponsors. Having a fund dedicated really makes you far more efficient an investor, and that was another crucial part of how the Upfund came to be. So let me give you a little bit of background on what the Upfund was. And I should say is, because the fund is still active. The investment period has closed, so we finished making investments. But it was a $50 million pool of capital set up to finance short, intensive training programs that could move low-income workers into jobs that paid 2 to 3 times what they were earning beforehand. The problem we were trying to address with this capital was that many of the people who stood to benefit from these programs, these training programs, had no credit history, no college degrees, and really fundamentally no access to traditional student loans. So careers in areas like HVAC, nursing, IT, et cetera, were just simply out of reach for these members of the workforce. Great example was a man from Chicago who had very poor credit history and had been turned away from a coding program only 12 months prior, came to us and through a loan from the Upfund was able to get through the IT training program and land a job as a cloud developer at about $70,000 a year. So perfect story of what the fund was set up to do. The fund ultimately expanded access to training in ways that even the providers could not do on their own. And so this was sort of the magic that Upfund was set up to accomplish. So hopefully with that, I've provided a little bit of the context for how we got to the Upfund and what core purposes we were trying to serve or solve with the Upfund. Maybe in the Q&A session, I'll talk a little bit more about some of the lessons that we learned. There were many along the way and the resulting pivots, which kind of brings me to another one of my overly verbose insights on the other page. And that is that it is entirely within the realm of possibility and probably expectation that a fund investing catalytic capital is not going to go perfectly to plan from day one. And so my advice there is just over communicate heavily. What are your goals? What are the risks that you expect to encounter? And just be clear with investors that a pivot or more than one pivot is likely to take place along the way. Anyway, Upfund was just the start. I arrived at Social Finance in 2022, so 2 years after the launch of the Upfund, and that was in the midst of a flurry of follow-on career impact bond-like vehicles that we have since launched. Now, one of them was with Google, and we refer to it as the Google Certificates Career Fund. And that fund is seeking to empower 20,000 learners to realize over $1 billion in wage gains. We've also launched a number of, here come the acronyms, PIFs, which stand for, I'm completely forgetting, pay it forward funds in multiple states, ranging from New Jersey to Colorado to Ohio. These were more place-based in nature, but the idea was the same. And this is the brilliance of what the Upfund was able to launch was evolution, if you will, of this workforce funding. So today, the team, the Workforce and Education Investments team at Social Finance manages 12 active funds in workforce and education, catalyzed over $300 million in capital, catalytic capital, 17,500 learners, generating a median wage gain of $11,800 across a portfolio. It's about a 40% increase. So the toolkit that the Upfund launched has become a practice built around catalytic investing. The final comment that I'll make before we get to Q&A, and it can almost shoehorn my way into the second bullet that I have here, is that impact investing sits along this delicate continuum between grant making and traditional investing. We know that grants return a negative 100% financial return to its donors, but achieve tremendous amounts of invaluable impact. The S&P has returned about 10%, right, over the last 100 years to its investors. Catalytic capital sits somewhere along that spectrum. And depending on the income that you're trying to, the impact that you're trying to generate with that capital, you can have very different outcomes. So let me just give you a couple. A 50-cent return is a bad outcome if you needed a dollar back, right? I think anyone will acknowledge that. But it's a perfectly okay outcome if you understood going in that that 50 cents was going to generate wage gains for workers who needed them. Even if I only get 50 cents back on my dollar in that type of investment, I don't think of that as a failure. It's a different form of success. So again, I might leave you with this: over-communicate the objectives that you're seeking to achieve with your impact. Stay true to the mission, stay true to your process, be transparent with your investors, and Fund 2 will be well within reach. Charles, do I hand back to you?
I think thank you, Stephen. Appreciate that. And thank you for coming back to the spectrum of capital. Deepa, do you want to take over from here?
Yeah, for sure. Can we go to the next slide, please? Thanks so much. So my name's Deepa Iyer. I'm an advisor to C3. And first off, thank you so much, Santiago, Keisha, and Stephen, for sharing your perspectives with us today. Just so many invaluable insights for the ecosystem. Some gentle guidelines on Q&A for everyone in the room. Please share your questions directly into the Q&A feature, and we'll select a few to ask based on time. A few pretty self-explanatory ground rules enclosed below. I may start us off with a couple of questions for our panelists today. Some of this, I think, was shared a little bit, but just wanted to double click a little bit. For all three of our panelists today, as you look back, what was really the single biggest strategic change that you feel you made between Fund 1 and Fund 2, or in social finance's case, subsequent funds? And what drove those decisions for you, whether it was evidence from portfolio exits or LP feedback, various market or portfolio signals? Would love to learn a little bit more there. And we'll maybe start with Santiago to go in the order that you presented.
Sure, Deepa. So, I mean, I think in terms of our investment strategy, an important change that we did, it was sort of the need sort of to adjust how we were thinking around impact. And as mentioned sort of earlier in the introduction, Alive's incentives, meaning the carry, it's tied both to financial performance, of course, but also to impact performance. And for our first fund, we created our own impact framework, and it was primarily, it was a bit complex, but it was primarily designed sort of around this notion of breadth of impact, numbers of lives impacted. But having a multi-sectorial fund created a lot of complexity in terms of how we would look sort of at that breadth of impact. Imagine comparing the breadth of impact of a company operating in the agribusiness space, benefiting low-income farmers, with another company in the education space, an education technology company, providing access sort of to pertinent education through the web, meaning reaching millions of lives compared sort of to, the hundreds of smallholder farmers. So, to keep it brief, the complexity of our first framework created some challenges sort of along the way. Thankfully, we had extremely collaborative partners, meaning in our LP base, that they understood sort of that we were all learning as part of this process, and they were all key, partners sort of to make the adjustments required along the way to make it work. But then for the second fund, what we did is actually before we committed sort of to an impact framework, we did a deep research in terms of what was out there in terms of measuring impact. And ultimately, we ended up selecting the impact management project, the 5 dimensions of the impact management project, as the framework that we are now using to measure impact, and as the framework that it's dominant in our as the tool sort of that we are using to link our carry to impact. And the IMP provides not only a tool that is now being widely used by several, I think it's in the hundreds of investors, but it's actually also a tool that provides the flexibility to be able, to tackle this issue, regardless of the sector in which we're investing, regardless of the stage of growth of the company in which we're investing. Still being very rigorous about sort of talking about the impact, but then now also broadening the impact discussion multidimensionally, not only about breadth, but also about depth, about the who, the how, the what of the impact. And I think that has been transformational in terms of how we grow internally and with our investors as well, around thinking and around measuring impact.
Super helpful. Thanks, Santiago. Keisha, Stephen, any thoughts to add there?
I'm happy to throw in a couple thoughts. We had maybe 2 more pronounced challenges. Well, to begin with, I talked a little bit about how we pivoted from social impact bonds to the career impact bonds of the upfund. And as Santiago said, a lot of that was reducing complexity and proving continuity of process. Not to get too in the weeds on the fund, but there were 2 challenges that we faced. One was that the learners that we put through these programs did not have any upfront cost to the training. The repayment of their loans came after the fact. And as you have more time expire from graduating from the program, getting your job, that becomes more difficult. And so we had some learnings there about how that process should evolve, and I can come to that. And then secondly, probably most importantly, the whole point of these learning journeys for these folks was to get the jobs at the back end. And it was clear that the structures that worked best were the ones where the employer had a genuine labor shortage and was connected to the training from the start. And so probably the biggest evolution that we did was to ensure that the providers had a bit more skin in the game, and that there was a clear connection to ultimately the folks that were offering the jobs. And that has shown up in many of the subsequent vehicles that we've launched.
Thanks, Stephen.
I'll jump in just quickly. I think the what we learned sort of Fund 1, Fund 2, and now what we're employing for Fund 3. Fund 1, we had 2 exits of companies that were sort of pre-2020, a little early in my opinion. One was a technology that was supporting corporations with identifying diverse suppliers for their supply chain, and that was bought by a large corporate player. The other one, and that company was Connexus. The other one was Scoozilla, a company that was early on in sort of real-time data for teachers and administrators to ensure children were being paid attention to in real time versus the lag data from pen and pencil. That company was bought by a strategic private equity, a larger ed tech company as well. And those companies, I thought, like, dang, if the market just recognized how important these companies were, they could have raised more money, built more value, and then exited versus sort of having an early-ish exit, which did return some capital, but not sort of the venture-like run that we're hoping for. So for Fund 2, we sort of doubled down in a strategy that we were doing bridge investments, that we were helping companies that couldn't raise that next price round to bridge them to that next price round, to buy them more time so they could build more value, not sell for sort of quote unquote less than what they were worth, or raise capital at terms that weren't attractive. So we did a number of bridge investments, a bigger conversation. Some of them worked, some of them did not work. And then and what we realized is that while yes, all of that's true, and we can't be the only fund as a small fund sort of holding the bag on any one investment. So for Fund 3, similar to some of the comments that are already made, we are ensuring that we are co-investing with syndicates of investors that really, really care about the mission of the company. In Fund 2, we had some highly notable names that we co-invested with, that when the rubber met the road, no more dollars, no more support. And so who we're investing with to ensure that we're all sort of in it, holding hands together on the journey has been become increasingly important for us.
Super helpful. Thank you, Keisha. I see we've had several questions being put into the Q&A. So I'm going to start off with one that seems quite interesting and builds on this last question. So a specific question for Santiago, actually. So an anonymous attendee is asking, there seems like there's a big change in investor type between Fund 1 and Fund 2, with a larger share of DFIs and less from foundations. Do you consider that to be a success of Catalytic Capital, or do you feel like DFIs would have invested anyways? Why?
Yes, very good question. And for us as context, we believe the DFIs they are, and they will be, like core or key partners of ours, for along the way. The development finance institutions, they have natural alignment with our strategy, in the sense that they strategically sort of want to provide capital sort of to emerging markets, depending on their strategy, which geographies. But what they found, I think, the alignment that they found with Life is sort of that convergence of providing capital, but sort of to support the kind of underserved segments of the economy within the markets in which we operate. And so what's been really interesting for us is that initially, when we launched, there were very few DFIs that actually supported us and believed in us, because they had sort of these requirements about sort of track record and traction that we just didn't meet those requirements, and also about scale, because for them traditionally, especially the Europeans ones, that they required sort of to deploy large checks or amount of capital that we, of course, as first-time fund managers, were just sort of trying to reach to the 20-30 million range. And so in our second fund, we feel really excited sort of that we've been able sort of to bring on board 3 new DFIs, European DFIs, that they've seen sort of that the work that we've done, even though in scale is still below the 100 million, which is probably sort of what would be kind of their sweet spot. The quality of the work that we're doing and the type of companies that we are supporting, and I think the depth about sort of the work that we're doing in terms of measuring impact and really understanding what's working and what's not, and how we're even communicating as well with them. The DFIs are known sort of to be very heavy in terms of reporting. But for us, as mentioned earlier, it's not about reporting. It's about partnership. It's about communicating. It's about sharing knowledge, experiences. And so I think we've done a good work on that respect. And so they become also really good partners because of the depth of their work. They can also provide not only the capital, but also technical assistance, other ways of supporting our portfolio. We feel excited about sort of that partnership. And I think probably the next level would be to bring more local investors. I think that's where we're lacking. We've even seen a contraction from Fund 1 to Fund 2 in terms of local capital. And there's a geopolitical phenomenon in Latin America that has had sort of that impact. But we're hopeful that in our next iteration, in the third fund, if we were able sort of to close the cycle, especially of the first fund, which needs, it's starting sort of to return capital, then hopefully we will maintain the DFIs, but then we'll be able sort of to bring more local investors to the equation.
Makes sense. Thank you. And a follow-on question from the same participant. It seems like commercial capital increased a bit in all of your subsequent funds. And so they're asking, what do you attribute that to? Return from Fund 1 or other factors? Any thoughts, Stephen, Keisha, Santiago?
Sure. I think in the context of our experience with corporates, we have this Google Career Certificates Fund that's partly corporate, partly foundation. I think generally when we engage with corporates, it typically comes from the foundation side of their work, because the capital that we're deploying is truly catalytic. We hope to return the capital with potentially a modest return, but it is catalytic in nature. And so the impact has to prioritize. And that very rapidly eliminates a lot of corporates from having an interest. But there are those that have pursued, and we got capital in a new iteration of a fund from UBS through a donor advised fund of theirs, for example. And so as we have pivoted to new investors, and we haven't dramatically, foundations continue to be a very important part of our work, high net worth philanthropists also, but a lot of the capital at donor advised funds, which is a fascinating, growing $300 billion plus pool of capital where the tax breaks have already been received. And the whole point of donor advised funds is to be impactful. But, as many of us know, much of that capital sits in a money market account waiting to be granted. And so our pitch to many of those donor advised fund holders is, why not be impactful with those dollars? We will strive to invest in a way that we can return your capital at a certain point in time, and you can continue to grant it as you wish. But as it sits in, as the $300 billion sits around, why not make it more impactful? So that's technically still in the foundation world, right? Because it's Fidelity Charitable, it's Vanguard Charitable, and those are all forms of foundations. But a lot of good progress there happening that we've seen in the shareholder base of our investment funds.
Thanks, Stephen, Keisha, Santiago. Anything to add there?
Yeah, I just add, it's the uptick, right? It's for a venture fund. It's what does the portfolio, the markups, et cetera, look like at the time of raise? And it's also the macro environment of what do people care about? And so when we raised our $112 million Fund 3, we raised it in 2022, before 2024, before the political shift and the political change in America in 2024. And in 2022, sort of post-pandemic, you know, a lot of conversations about racial inequality, the double, you know, pandemic, you know, COVID, the impact on low and moderate income people. So this conversation around inequality in America was happening, and it was happening quite loudly, where institutions had, corporations and financial institutions, people had made commitments to do something different. A lot of those commitments did not follow through, but many of them did. And so there were pools of capital that was specifically looking for both great opportunities, where are those overlooked markets, great opportunities, where is their need, and where is the impact to start to chip away at these systemic issues that we all can see now. And so we caught the wave. We had we have a couple unicorns in our portfolio. We were early investors in an Isuzu, and there are other companies that I can name. We've had a couple of exits now out of Fund 2. So it was, can you identify these overlooked markets where you can have scale of impact? And so thousands, in some cases millions of people have been impacted by our portfolio companies. And is it the right kind of cultural timing moment where institutions and champions inside of institutions actually care about their problems? So I think we caught that wave, and hence we're able to raise from financial institutions, banks, more commercial partners for our Fund 3.
And I would just complement quickly, Deepa, is that, you know, when we get started, sort of initially, short-term goal is you know, the first fund has to work and, you know, focus there. But really, ultimately, Alive, we've created Alive sort of to, you know, foster an ecosystem, to really prove that it is possible sort of to deploy capital in ways in which you can achieve both financial performance and then also social impact. And I think that is especially true in Latin America, where the inequality gap is the biggest, you know, globally. And thankfully, like, technology has been an enabler sort of to be able sort of to reach underserved segments of the economy with high quality and affordable products and services. And so, you know, first fund that commercial investors would, you know, it was really hard sort of for them sort of to kind of understand what we were trying to do. And that's why, you know, the catalytic capital was so critical, and catalytic, you know, by definition. And I think, you know, that's why we're so thankful also to C3, MacArthur, and all the work sort of that and support that provided to us. But, you know, for us, you know, if we think about sort of success, is because, you know, down the road, there will be, not only in Alive, but actually in more fund managers or more, you know, asset managers, there will be much more commercial capital deployed in this way, and in different ways. You know, there is a spectrum. It doesn't have to be exactly sort of what we're doing, but in this spectrum of conscious capital. And so, you know, in our second fund, we saw a portion of that. You know, there is some a portion that now commercial capital that is coming into the table, and we're hopeful that that trend hopefully will continue growing, because catalytic capital is very scarce as well, and then we really require commercial capital. I think Keisha mentioned something that is really important, which is about sort of, you know, the scale of impact that is required. And so to reach a scale, we need that commercial capital to be part of this discussion.
Thank you all. Interesting question from Nikhil Bum at FSG. He asks, can the speakers expand on the earlier insight of protecting catalytic capital in a separate fund? Would love to hear more about the trade-offs and what they enabled. Any unexpected insights, positive or otherwise? I think, Keisha, you also spoke a bit about separate nonprofit vehicles that are offering you know, technical assistance, other types of services. But would love for the three of you to maybe elaborate on this a little bit.
Yeah, I wish I would have been more thoughtful about my structuring. And I think folks are now, and I hope investors, and I know social finance is very creative and innovative in its structure, and hopefully encouraging others to be as well. So I did not. I came out and I said, I'm going to be structured like a 10-year venture capital fund, and I'm going to do all of these things and these things and these things and these things. And we felt, to be very candid and transparent, we felt the weight of trying to do the yes and yes and yes and yes and as a small, growing, emerging manager that's trying to navigate and figure the space out so that we can achieve our mission of financial returns as well as impact. And we've learned from that, right? And so I just encourage others, if there is a yes, and then there typically needs to be, if you want to serve underserved communities, or if you want to serve and invest in first-time founders, it comes with more support, because we've been left out of the equation for so long, and so we have to get ourselves ahead. And so for us, it's interesting because we do have a mix of both catalytic investors. I just had my LPAC meeting yesterday, and the folks around the table, MacArthur, Ford Foundation, Kellogg Foundation, and then I have representative from Cambridge Associates, as well as two very large family offices. And so I do think there's a mix of sort of expectations. Everyone's there because they care about impact. They also care about financial returns, and some people care about financial returns more than other people. And so it's, how do you balance that out, and how do you manage as an impact investor? And we all know this all too well. How do you manage that tension and that intersection of both impact and financial returns? And that's the work that we sign up to do, but there is a constant juggle between the two.
Thanks, Keisha. I think interesting question from Zoe McKenzie, maybe for us to end on, cognizant that we have about 3 more minutes. Zoe asks, you spoke about how your investment thesis creates impact through your portfolio. I'm curious whether any of you have also developed or been the beneficiary of models of impact that have supported you as fund managers. Have you structured new funding mechanisms, partnership models, or forms of ongoing participation that prove transformative for your fund? If so, how did you establish those models, and what lessons would you share with others looking to do the same? So curious if each of you have a couple of insights to share on that to close us out.
Well, I can offer that as we have experimented and raised different types of pools of capital, we've almost always been supported with grant capital to evaluate whether it's how to mobilize more capital out of the donor advised fund community, or how to put a structure in place to address a very specific issue area. Grant capital has been critical in doing that, but candidly, I think also to credit the efforts of social finance a bit, you have to put yourself out there to do the work, and appreciate and assume that there are those that are willing to fund that, at least over the near term, and then move forward with it. But there are just a lot of, and MacArthur and C3 is a great example of that, of how important it is to get that support early on, to take the risk that it may not work out, but that ultimately, if what you're structuring can drive impact, those that are seeking to have impact success with their catalytic capital are likely going to be there to support. That's what we have found.
Thanks, Stephen, Keisha, Santiago. Maybe one lesson to share with the field from each of you to close us out.
Probably just a quick lesson, and is that this is an ecosystem play. This is not something that I don't believe that each of us, working independently or singly, will actually succeed alone. This is an ecosystem play, and if just the awareness of that from the onset is, I think it is crucial to to get to a good start, and the possibilities of developing long-term partnerships with folks that believe in the same values and in what you're trying to achieve, and that can be there to give you a hand, not only in terms, of investment, but in terms of expertise, in terms of network, in terms of whatever, I think is crucial, because this is, as Keisha mentioned, I mean, this is really hard work. It's really hard work. I don't think it should be underestimated. And so having a support network and a partnership, collaborations, and so on, I think is just fundamental to for the long term.
And then just quickly, what I'll say is, as someone that set up a venture capital model, that, venture capital is sexy, we can scale impact, and we have, like, millions of people have been reached, and we have our exits, and we ride the waves. But right now, particularly as you think about America, there is a spectrum, as Santiago mentioned, of ways in social finance is doing it. We need to reach people. We need to reach communities, and that can come in the form of investing in local businesses. I'm giving a shout out to my friend Jessica Norwood, who's here from Rooted Runway, and they invest in small debt capital into small local businesses, and that's important for the ecosystem if we really say we care about job creation and community development. So I just encourage those of you who have capital, those of you who want to move money, there is a spectrum. Really do what's in your heart, your desire, what's going to get you up every morning to do, and do it well. And I do think if we all continue to chip away at this, we got a lot of pushback because of the progress we're making. So let's keep making the progress to get capital out the door into the communities we care about.
Thank you, Keisha. Such a great call out to the field at large. Thank you, everyone, for joining us today. That concludes our webinar today. And thank you especially, Santiago, Keisha, and Stephen, for sharing your perspectives. Really, thank you for the work that you do. And we are excited to keep hosting future webinars for the field at large to learn more about Catalytic Capital. Thank you all today.